Hello, everyone. My name is Alec Nicholas, and today I'll be looking at behavioral versus fundamentals in the market. So, the question that I'll be hoping to answer today is what matters more in the short and medium run? The fundamentals of various companies are behavioral finance and behavioral issues that many investors and institutions have to go through. So, to start off, the classic view on the markets is the efficient market hypothesis is that everything is already priced in and that the value of the company reflects the future earnings stream that's discounted, which can be seen in a DCF model. And I believe that the efficient market hypothesis can be debunked without words, but with actually just a series of tickers, which can be seen below, such as LFIN, ZM, Zoom, LBCC, TLRY, BYND, Tesla, KODK, the VIX, and countless other tickers. To go through a few of them right now, LFIN was really the first absolute fraud that I encountered. This company started off in the blockchain space, IPO'd, went absolutely through the roof, and then would eventually become T12 halted and go from a high of around 130 per share to become a penny stock. And I do have a prior video on that. Zoom versus ZM, I'll go on in other slides, but essentially, ZM is the company that everyone thinks of during this time. It's the company that allows for video conferencing, and it recently became public. And ZOOM was the old ticker for an old Chinese company that is essentially hasn't put out any reports in the last 4 or 5 years, and it hasn't had any business recently. Or essentially, people got the two tickers confused. LBCC is also similar to KODK and LFIN in the fact that it took advantage of the blockchain craze that we saw in around 2017. It was actually a Long Island iced tea company, which then pivoted its business plan and said that they changed their name to Long Blockchain Corporation and stated that they would do stuff with blockchain. When they changed their ticker and changed their business model, they tripled in one day, and that would soon teeter off. Kodak, the camera company, did something similar. They said that they were going to create a Kodak coin, which caused their valuation to triple, and then ended up doing absolutely nothing involving the blockchain just to essentially give in to the crazy investor sentiment over the cryptocurrency at the time. Tilray and Beyond are two companies that were kind of the hot new thing, and it caused investors to not focus on the fundamentals, but more so of, oh, what could this be, and only pricing in the best case scenarios. These companies could double in 1 week and halve in the next week. Obviously, their fundamental outlook doesn't change dramatically in that short period of time, but it caused their valuation to absolutely change to mind-boggling numbers. And the last ticker that I want to focus on and touch on in this presentation is the VIX, which can be thought of as a fear gauge. It can be thought of as a measure of how expensive calls and puts are, and it's determined by the price of out-of-the-money calls and puts on SPX within about like a 30-day window. And I'll have another video specifically on the VIX in the short term, but it's mean reverting, and its spikes can also be thought of as quasi-irrational as volatility picks up, and that's when investors usually choose to hedge with buying puts to hedge their portfolio when it's already down. It's akin to, many people believe, buying hurricane insurance. As soon as a hurricane happens, the hurricane insurance goes up right afterwards, and that's when the insurance is most expensive and when most people buy the insurance due to recency bias. I know this is Zoom versus ZM, and it can be seen that in this case, actually choosing the wrong ticker resulted in a vastly larger ROI than actually purchasing the company that you wanted, which would be ZM for the company that does video conferencing. There are many reasons people did this. They knew the company was called Zoom Technologies. They just typed in Zoom and bought the wrong ticker. That could be one irrational investor just not doing their due diligence, making sure they're purchasing what they want to purchase. And another possible case is if people thought that other investors would buy the wrong ticker, then they might have actually bought ZOOM knowing that other people would make a mistake and buy the wrong ticker. There's definitely a few people who did do this, and that would be a very promising ROI for them. And then since this event, the SEC actually paused trading and then made the Chinese company who had the ticker ZOOM to change their ticker due to investors becoming just buying and buying the wrong company that hasn't done anything for years. So now, recently with coronavirus, also known as COVID-19, this caused extreme fear in the market, and the VIX essentially set record all-time highs since its creation. If the VIX were around during the Great Recession and the 87 crash, it would have probably finished higher than it has in recorded history, but the VIX and the VIX term structure was actually higher than it was in 2008, even after Lehman crashed. So right now, well, back a few months ago when this first started to happen, like the Graham and Buffett approach of looking at companies with strong fundamentals would essentially be impossible, as there was increased uncertainty over the fundamental models. Projecting a company's revenue for the next few quarters when this is a very unprecedented time, everyone's staying at home and quarantined, is essentially impossible to do. And it was even seen that Buffett did not make any new deals, which is fairly surprising. And instead, he sold off all of his stock in the airline companies. I'm sure there's other companies that he lessened his exposure to during this uncertain time. And also, during this uncertain time, we've experienced a very fast V-shaped recovery in the market, which can be seen by now the NASDAQ being essentially flat on the year. Even though a lot of the tech companies have been fairly insulated, the fact that the real economy is pretty much the worst it's been since the recession in 2008, and more people are unemployed now. The GDP had a negative 4.8% print for Q1, PMI is lower, etc., and all of the other metrics have greatly deteriorated, and this isn't currently being seen in the market, even though one would presume that the future revenues and future free cash flow for these companies should be less, as no one is spending money right now. But this shows that the markets, at least in the short term, aren't very efficient, and they can also vast other vehicles such as the Federal Reserve can play like a huge influence in the medium to short term with injecting a ton of liquidity. So in conclusion, I want to finish off with a Buffett quote. He simply attempts to be fearful when others are greedy, and to be greedy only when others are fearful. So people were very fearful when the SPX was around below 2,500 and even at 2,200. But it be seen that Buffett actually did not make any deals at this time, so he clearly believed that people should be more fearful, and it wasn't his time to be greedy just yet. And the Federal Reserve, with its lending programs, kind of interrupted his ability to be greedy with the various companies. And instead of the markets being rational and trying to value a company based on the fundamentals, we actually see parabolic increase in assets and rapid decrease in assets. For instance, some of these parabolic increases that can also be seen in Tesla don't make any sense, especially when you consider that their CEO says that the company is overvalued and the stock price is still above the stock price when he sent out that tweet. And there are many instances that will happen that haven't been found yet of the hot new ticker swaying away from its fundamentals.